If you just glance at the headlines right now, the economic indicators are, well, they're flashing yellow. I mean, oil prices are climbing. Credit card rates are actively squeezing the everyday consumer, and geopolitical tensions are just running hot everywhere.
Yeah, they really are.
Right. So logically, you would expect corporate earnings to reflect that pressure. You'd expect a pullback. But then you crack open the data for this Q1 2026 earnings season, and the individual company report cards are just, they're glowing green. The stock market is tearing upward. Welcome to our latest deep dive, by the way. I'm so glad you're here with us.
It's great to be diving into this one because honestly, it is the absolute definition of a macro-micro disconnect. Like the broader economy feels heavy to you and me, but corporate balance sheets are operating like they are in a completely different reality.
Okay, let's unpack this because the contrast here is wild. Our mission today is to distill all of this. We've got a massive stack of sources, FactSet, Wall Street Horizon, Charles Schwab, and we're looking directly at the company earnings reports. We want to figure out the biggest beats, the surprising misses, who's actually raising guidance, and, what the experts are saying about the real health of the economy.
Yeah, and the goal here isn't just to read a list of numbers to you. We want to understand why the market is reacting the way it is. We need to spot the patterns beneath the surface. And a great place to start is with that S&P 500 data from FactSet.
Right, because the S&P 500 is currently sitting on a 15.1% blended earnings growth rate.
Which is huge.
It really is. And just to clarify that term, because it gets thrown around a lot in the financial media, when FactSet reports a blended rate, they are just combining the actual verified results from companies that have already reported this quarter with the latest Wall Street estimates for the ones that haven't reported yet.
Okay, makes sense.
So it basically gives us a real-time aggregate snapshot of the entire index. Right. So taking that blended snapshot, if this 15.1% figure holds up, we are looking at the sixth straight quarter of double-digit earnings growth.
Yeah, sixth straight.
That is a rare streak of resilience. I mean, it's not just revenue growth either. They're keeping way more of the money they make. The net profit margin for the S&P 500 has hit 13.4%.
Which is pretty staggering.
It is. That is the highest margin FactSet has recorded since they started tracking this specific metric back in, 2009?
Exactly, 2009. And it's counterintuitive when you factor in inflation, because you would naturally assume rising costs would eat into those profit margins.
Right. Materials cost more, labor costs more.
Exactly. But these companies have proven they can pass those costs directly onto the consumer without destroying demand.
So the numbers are undeniably strong. But before we get into the tech giants that are driving so much of this action, I want to look at the psychology behind the numbers.
Yeah.
Like, how do the executives running these companies actually feel about the near future?
Oh, that's the real question.
Because to really understand this earnings boom, you have to understand the soil it's growing in.
Right. Absolutely. And if we connect this to the bigger picture, one of the most reliable leading indicators we have isn't what CEOs say in their carefully scripted press releases.
Right, because those are always going to be optimistic.
Exactly. It's how they behave.
Yeah.
There's this fascinating metric from Wall Street Horizon called the LERI. It stands for the Late Earnings Report Index. And it basically tracks corporate body language.
Oh, I love that concept, corporate body language. How exactly does an index measure that?
Well, it tracks outlier changes to when companies schedule their earnings calls.
Like moving the date on the calendar.
Exactly. The psychological premise is really simple. Human nature dictates that if you have bad news, you tend to delay it. You push the meeting back to buy time, figure out a spin.
Oh, yeah, like putting off a dentist appointment.
Right. But if you have incredible news, you want to shout it from the rooftops immediately. You want to get it out there. So, if a CEO pushes an earnings date back later than their historical norm, it signals uncertainty or trouble. But if they move it up, they are eager to share.
So it's essentially an aggregate tracker of corporate eagerness.
That's a perfect way to put it. So the baseline reading is 100. Anything above 100 means a majority of CEOs are delaying, which indicates they are feeling uncertain about their financials or the broader economy.
Okay, so what's the reading for Q1 right now?
The Q1 reading right now is sitting at 55.
Wait, 55, like almost half the baseline.
Half. It is a record low.
Wow.
It strongly suggests that management teams aren't just weathering the inflation and the geopolitical noise. They feel they have an incredibly clear, confident view of their near-term profitability.
But wait, if CEOs are so confident, why are bank CEOs like Jamie Dimon still flashing warning signs about the consumer? Are they just hedging their bets?
That tension right there, that's what reveals a major fault line in the current economy. To understand Jamie Dimon's caution, you have to look at how these massive Wall Street banks actually made their money this quarter.
Because it wasn't through traditional consumer banking, was it?
No, not at all.
Let's look at those numbers really quick. Goldman Sachs posted a record $5.33 billion in equities trading revenue. Their earnings per share came in at $17.55, and analysts only expected $16.47.
Which is a massive beat.
Right. And Morgan Stanley saw their profit jump 29%. Bank of America just delivered their highest earnings per share in 2 decades.
2 decades!
But here's the catch. According to the analysis from Jariv, those profit beats are not coming from everyday people taking out mortgages
Right.
or small businesses taking out expansion loans. They are driven almost entirely by market volatility. The trading desks at these banks are just feasting on rapid price swings in the stock and bond market.
Because they act as the middlemen.
Exactly. And when the market is choppy, the middlemen make an absolute fortune.
Okay, so the banks are making a killing on institutional trading, not consumer lending. Precisely. So when Jamie Dimon looks at the traditional retail side of his bank, the credit card balances, loan defaults, auto loans, he sees everyday people really feeling the squeeze of higher interest rates.
Right, the flashing yellow lights.
Yeah. But when he looks at his trading floor, they are breaking records. It really is a tale of 2 economies. Wall Street is thriving on the very choppiness that makes life so difficult for Main Street right now.
And the volatility those bank trading desks are profiting from, it isn't random. It's being driven by a massive structural rewiring of the economy, which brings us directly to the Magnificent Seven tech companies.
Oh, yeah. The heavy hitters.
Because the amount of money they're pouring into artificial intelligence infrastructure is fundamentally altering the entire stock market landscape.
The scale of the capital expenditure, or CapEx, is honestly difficult to conceptualize. According to reports from The Guardian and Charles Schwab, the Mag 7 companies are projected to spend between $650 and $700 billion on AI infrastructure just in the year 2026.
$700 billion. I mean, that's not a corporate budget. That's the GDP of a medium-sized country.
It is.
Dedicated entirely to data centers, cooling systems, and silicon chips. And we are seeing the market's reaction to this spending play out in the earnings reports with brutal clarity. Let's look at Alphabet, for example.
They had a phenomenal quarter.
Right. Revenues were up 22% to $109.9 billion. But the real star of the show was Google Cloud. Revenue there shot up 63% to $20 billion.
And that cloud growth is entirely driven by enterprise AI solutions. Like, companies everywhere are realizing they just can't afford to build their own AI supercomputers from scratch.
It's too expensive.
Way too expensive. So they have to rent the computing power from Alphabet. And Alphabet has so much cash flowing in from this rental model that they even announced a 5% dividend increase.
Now contrast that with Microsoft. They posted very strong overall revenue, $77.7 billion, up 18%. But they took a $3.1 billion net income hit directly tied to their investments in OpenAI.
Right, the costs are catching up.
And then there's Meta. According to that Charles Schwab analysis, Meta actually missed Wall Street's profitability expectations because of their aggressive AI spending. And their stock was aggressively punished for it.
It really took a hit.
It's like building a massive multi-billion-dollar highway system before any cars exist. Wall Street is rewarding Alphabet because they already have toll booths set up and are making money off the traffic today, but they are punishing Meta because they are just pouring the concrete with no clear plan on how to collect the tolls.
What's fascinating here is that the market psychology has completely flipped from just a year ago.
How so?
Well, last year, simply mentioning the letters A and I on an earnings call would send a stock soaring.
Oh, yeah. Everyone was doing it. Just say AI and your valuation goes up.
Exactly. But that honeymoon phase is officially over. Institutional investors are now ruthlessly demanding near-term monetization.
They want the receipts.
They do. They want to see the return on investment for these capital expenditures today, not just a visionary promise for 5 years from now. If you are spending $10 billion on servers this quarter, you need to show the market the revenue those servers are generating this quarter.
But Wall Street isn't just grading these companies on how many AI servers they can buy or lease. They ultimately want to see how this technology reaches the consumer.
That's the real endgame.
Right. And the bottleneck for consumer reach is the device sitting in your pocket.
Yeah.
Which is exactly why Apple's quarter is sort of the missing puzzle piece here.
It's a huge piece.
While the rest of big tech is battling over cloud infrastructure, the company that actually controls the hardware, just reported a quarter that completely defied expectations.
It was a defining moment for them, really.
Let's go through it. Q1 revenue of $143.8 billion.
Yeah?
Profit of $42.1 billion.
Yeah.
And here is the metric that just jumps off the page. iPhone revenue was up 23.3% year over year.
Which is wild.
It's nuts. Think about the sheer market saturation of the iPhone. Hundreds of millions of people already have one. For a company of Apple's size to grow a mature flagship product by 23% in a single year is almost unheard of.
Yeah.
Plus, their revenue in Greater China exploded by 37.9%. I mean, Tim Cook called the demand simply staggering.
And beyond just the top-line sales, if we look at the FactSet data, the underlying mechanism driving Apple's valuation right now is their margin.
Let's talk about the margin.
Because there were widespread fears that rising memory chip prices were going to just eat into their profits this quarter.
Right. Everyone thought the hardware costs would drag them down.
Exactly. But instead, Apple delivered a 48.2% overall gross margin, and their services gross margin hit 76.5%.
Okay, let's dig into that services margin because 76.5% profit is incredible.
Yep.
That's the App Store, right? iCloud storage, Apple Music.
Right. And the reason that margin is so high is because the marginal cost of distribution is practically zero.
Oh, sure.
Once you buy the physical hardware, the phone itself, Apple doesn't have to manufacture anything else to sell you an iCloud subscription.
Right, it's just software.
Exactly. And once you are locked into that ecosystem with your photos and your data tied to their servers, the switching costs are just too high.
Yeah. No one is canceling your iCloud subscription just because grocery prices went up. It's a hassle to move all your photos.
It really is. It is pure ecosystem stickiness, and it proves they have unparalleled pricing power.
And they are managing this while facing serious hardware constraints. Like, they literally cannot get enough 3-nanometer chips to build phones fast enough to meet the demand.
Yeah, and we hear 3-nanometer thrown around constantly in these tech earnings calls. Fundamentally, what that means is the transistors on these specific chips are so microscopically small that you can pack billions more of them into the exact same physical space of a smartphone processor.
And more transistors just mean more computing power, right?
Exactly. But crucially, because the electrical signals have less distance to travel, they use significantly less power.
Oh, that makes sense.
Yeah, that density gives you a huge leap in processing capability while draining way less battery, which is the absolute prerequisite for running advanced artificial intelligence natively on a phone.
Right, rather than having to send a request up to a cloud server and wait for a response.
Exactly.
Yet, even with those supply chain bottlenecks on the 3-nanometer chips, Apple raised their guidance for the next quarter. They're projecting 13 to 16% revenue growth. And they aren't sitting out the AI race either.
Not at all.
Tim Cook actually confirmed they are collaborating with Google to develop the next generation of Apple Foundation models. They want to power a more personalized Siri later this year. So, Alphabet gets more cloud traffic from Apple's massive user base, and Apple gets advanced AI without having to spend $50 billion burning their own data centers.
It's a strategic masterstroke, honestly. Apple completely avoids the heavy capital expenditure penalty that the market is currently handing out to companies like Meta, while still delivering the AI features the consumer expects.
Okay, so Apple's record sales, Alphabet's cloud expansion, Meta's concrete pouring, every single one of these software ambitions relies entirely on physical hardware.
A physical layer.
Right, the data centers, the cooling systems, the silicon chips. Which brings us to the physical layer of the AI boom, the hardware enablers. And this is where the market logic gets really, really twisted.
It really does. It's where the expectations game becomes almost more important than the actual financial results. Let's look at the company that actually manufactures the silicon for Apple and NVIDIA, Taiwan Semiconductor, or TSMC.
Okay.
They are a foundry, meaning they don't design their own chips, they just build whatever Apple and NVIDIA design for them.
They're the ultimate pick-and-shovel company in the AI gold rush.
Precisely. TSMC reported a 40.6% jump in revenue. Their CEO publicly stated that AI demand is extremely robust, and they raised their full-year revenue growth guidance to above 30%.
And the market loved it, right? The stock surged.
Oh, that absolutely surged.
Okay, but here's where it gets really interesting. We have this idea that if a company beats its earnings, beats its revenue, and raises its future guidance, the stock goes up. It's supposed to be a predictable equation.
You would think so.
Right. But let's look at Western Digital and SanDisk. Both are heavyweights in the memory chip space. And AI requires vast amounts of memory to store data while the processors do all the complex math. Both of these companies beat their earnings expectations. Both beat their revenue estimates. both raised their guidance. And yet, Western Digital stock fell 7.4% and SanDisk fell 5.6%. So what does this all mean? If Western Digital and SanDisk beat their expectations and raised guidance, why did the market punish them? Does Wall Street just have impossible standards right now?
This raises a really important question about market psychology and valuation multiples. What you're seeing with Western Digital and SanDisk is the mechanics of buy the rumor, sell the fact. Because memory chips are largely a commodity. When the AI hype started accelerating months ago, investors knew that data centers would require a massive hoarding of memory chips. They bought into Western Digital and SanDisk aggressively.
Driving the stock prices up long before this earnings report was ever published.
Completely baked in.
So the good news was already baked into the stock price.
Exactly. To understand why the stocks fell despite the good news, we have to look at the forward PE ratio, or the price-to-earnings ratio. Currently, FactSet shows the forward PE for the broader S&P 500 is 20.9.
Okay, let's translate that 20.9 figure for a second. Think of the PE ratio as the premium you are willing to pay today for a single dollar of a company's future profit.
Exactly. And a multiple of 20.9 is well above the 5-year and 10-year historical averages.
So it's expensive.
Very expensive. When investors are paying that kind of premium, it means the company is priced for absolute flawless execution. The market isn't asking, did you do well? The market is asking, did you fundamentally change the trajectory of the universe? Western Digital and SanDisk reported great numbers, but their forward-looking guidance didn't blow the doors off the projections. So the institutional investors who bought in early looked at the results, decided the hypergrowth phase was fully priced in, and they just sold their shares to lock in their profits.
They're priced for perfection, and if you aren't perfect, you get dropped.
Yep.
The market will tolerate a lot, but right now it will not tolerate a lack of future momentum.
Yeah.
I mean, we saw a slightly different version of this with Roblox.
Oh, the Roblox drop.
Yeah, they missed slightly on current revenue, which the market might have forgiven, but then they cut their annual bookings forecast.
Which is a huge red flag for investors.
Right. They essentially told the market the future looks slightly worse than originally thought, and the stock immediately fell 18.4%. We also saw a surprise miss from Merck in the healthcare sector. They posted a huge loss, dragged the whole sector down.
That is the ultimate rule of this specific earnings season. You can have a messy quarter today if you are building the foundation for tomorrow. But if you tell the market your future growth is slowing down in an economy trading at a 20.9 premium, they will show absolutely no mercy.
So as we pull all these threads together, Q1 2026 really paints a picture of a bizarre split-screen reality.
It really does.
On one side, we are seeing historic corporate resilience. The S&P 500 is printing record 13.4% profit margins. Banked trading floors are generating absolute fortunes off market volatility, and we are living through an AI infrastructure frenzy where the biggest tech companies on Earth are pouring $700 billion into silicon and data centers.
But the key takeaway from the data isn't just the raw spending, it's the market's evolving standard for success. I mean, 84% of S&P 500 companies beat their EPS estimates this quarter.
84%.
Yeah. But beating the spreadsheet isn't enough anymore. The market is aggressively rewarding companies with clear, immediate monetization paths.
The ones operating the toll booths.
Exactly. While actively punishing companies that are spending capital without a clear map or companies that just fail to maintain their momentum, they're setting a very high bar for the rest of 2026.
And that leaves us with one crucial lingering thread for you to think about. We've talked deeply about the hundreds of billions of dollars being poured into servers, the premium prices for 3-nanometer chips, and the high costs of memory commodities. But think about the mechanics of how businesses operate. Those costs never just evaporate. They eventually get passed down the chain.
They always do.
So we've talked about the $700 billion big tech is pouring into AI infrastructure this year. But think about this. When the cost of memory chips inevitably gets passed down to you, the consumer, at the exact same time that credit card rates are squeezing Main Street, who is actually going to pay the final bill for this AI revolution? Wall Street is celebrating today, but Main Street's wallet is the ultimate decider. Keep an eye on that as we move into the rest of the year. Thanks so much for joining us on this deep dive.